Good afternoon. It's Jeffrey Christian of CPM Group. It's about 1:40 in the afternoon on Friday, the 1st of December here in New York. You'll have to excuse me. I have a terrible head cold, and I've been laid up in bed for the last 7 or 8 days with it. So we'll see where we can go. I want to talk about interest rates. They're driving the markets, not just precious metals, but across markets. And then talk about, what's happened, why it's happened, where we go from here, what are some realistic expectations, and then the importance for gold and silver and platinum group metals. So what's happened? Interest rates have fallen. These are just through since like March of this year on the left-hand side, 91-day Treasury bills. And on the right-hand side, the 10-year Treasury notes, two markets within the Treasury complex, the latter, that we pay the most attention to. You can see that both of them rose to big highs in the middle to late October and have come down. 10-year notes got about 4.8, 4.9%, almost to 5%. Now they're down to about 4.2%. T-bill rates, the short end, which is more influenced by Fed policy, had gotten up, and it's fallen less dramatically. So most of the decline in interest rates has been on the long end. The long end is influenced by the short end. The Fed manages the Fed funds rate, and it has most of its influence on the short end of the interest rate spectrum. The longer term interest-bearing assets are influenced by the Fed and by short rates, but they're also influenced by a whole lot of other factors related to the real economy, economic activity, the demand for credit from individuals, corporations, and governments, and inflation expectations and other factors. So what we've seen is long rates have come down much more sharply than the short rates. The 2-year to 10-year spread, which people like to use for the yield curve calculations, has been around 40 basis points for several months now. It had been up to around 80 basis points or so. It's contracted, but it's still, the 2-year rates are still higher both than the 91-day Treasury bills and the 10-year notes. This decline in interest rates is interesting because it comes at a time GDP for the third quarter has been ratcheted upward. Expectations for holiday period sales but to consumers have been increasing and are showing record levels of demand. You're seeing increased travel expenditures. There are a lot of strength in the economy, and we've just gone through this weird period over the last 4 months or so where the market consensus shifted from, we're about to fall into a recession if we're not already in one, to this posture, there's not going to be a recession. And now we're starting to see market consensus shift back to, there could be a recession in 2024. Now, since we've been expecting a recession in 2024, 2025 for several years, we sort of feel like, the market's coming in line with our expectations. But that's probably not true. Because if you look at that market consensus in 2021, 2022, earlier 2023, the middle part of this year, the market consensus has been, there's going to be a recession very soon, maybe within the next 6 to 12 months, if you will. So on the one hand, perhaps the market have shifted to a more realistic assessment of the underlying economic conditions, similar to what CPM Group, the IMF, the OECD, and other entities have. Or it could just be that expectation of an imminent recession and a decline in interest rates that these guys have been talking about for several years, they're still talking about the exact same thing. It's just moved forward in time to the point where it's now overlaying our expectations. It's hard to say. But there are some expectations of slower economic growth in 2024 in the United States, in Europe, in China, in several other major economies. And there's expectations that political issues, both international political issues and domestic issues, will have a negative effect on overall economic conditions. So it does look as though economic activity may soften next year. The Fed has stopped raising interest rates. It has indicated that it could if it feels the need to. Employment remains very strong. As I said, there are a lot of pockets of strength in the overall underlying economic and environment. And inflation has continued to move lower. So the Fed has less compulsion, as do other central banks in other countries, to continue raising interest rates. That does not mean that they will be immediately decreasing rates. And that's an important thing. I mean, there are many people in the markets who think in black and white instead of shades of gray. And the world moves in shades of gray. And you have to pay attention to that. It's one thing to stop raising rates. It's another thing to lower rates. Right now, the market consensus, as measured by the CME Fed Watch, is that rates might start falling sometime in the March to May period of time. There's a FOMC meeting in March. There's another one in May. That may be reasonable, but it all will depend on economic conditions going forward as they develop. If there are signs of economic strength, the Fed will be disinclined to lower rates along the lines of what we've seen over the last 3 or 4 months. If there are signs of economic weakness, or that the dysfunctional political system in the United States is having a negative effect on overall economic activity and investment plans by both investors and consumers and corporations, then the Fed might, in fact, be more inclined to start lowering rates. It all depends on what the economic environment is, right? And if you've got these doom scrollers who continually talk about how the world's going to collapse, the treasury is going to collapse, inflation is going to skyrocket, the dollar is going to collapse, just doesn't make sense, right? It all depends on what is going to be happening. And right now, it looks like the economies in the United States and other parts of the world, while they may be lower next year, and they may be of increased vulnerability to a recession, a couple negative quarters. That recession, if it does occur, may be more shallow than CPM Group and others had anticipated, or it may not actually occur. So we're in this transition period, and it behooves investors to say, just because the Fed is not raising rates further doesn't mean they're imminently going to decrease rates. And it's very interesting. I mean, you see these commentaries, and the commentaries seem overly enthusiastic about the economy and about the idea that you're going to see lower rates. They seem overly enthusiastic on timing and on levels. Now, if you look at the Fed Watch, they're saying, okay, we might see a 25 basis point cut as early as March, and maybe another 25 basis point cut as early as May, or maybe not, but you have other people who are talking about imminent interest rate cuts. They're ahead of the game. They're ahead of the world. They are desperate to find reasons to be bullish on other assets. And the only way that's going to happen, in their view, is if interest rates fall. So you got to be very careful. Interest rates do look like they peaked, and they may decline at some point next year. But then the levels, the scope of the decline also bears watching, right? I mean, the Fed Watch has rates falling to about 4% by next December. Over the next 13 months, a decline in Fed funds rate from around 5.25% to 4.5%. Over 4% on the Fed Watch. Other projections and the consensus forecast that some economics groups pulled together have it at about 4.5%. So a relatively modest decline, at least over the next 12 months or so, in interest rates. That doesn't mean that gold prices cannot rise. It just means that you have to have a bit of perspective. And those of you who have watched us for the last several years or read our work for the last half a century, you know that we like longer-term perspectives. Here is the longer-term 91-day T-bill rate, and here is the 10-year Treasury note interest rates. And you can see, yes, they've been rising very sharply since 2022, the beginning of March of 2022. They are still low by the levels that we've seen for most of the period from the 1960s up until 2008. And that's true on both the short end, 3-month T-bills, and the 10-year notes. So there's a lot of scope for rising rates. One of the things that has surprised a lot of people is that the Fed has been able to raise short rates from 0%, 25 basis points, to 5.25%, 5.5% over the last year and a half, and it hasn't thrown the economy into a recession, and it hasn't really slowed economic activity. 5% real GDP, the latest estimate, or more than 5% for the third quarter. Labor markets remain strong, and a lot of other economic factors look good too. So you got to put the pace, the timing, and the levels of interest rates into consideration. A couple other short points. This is the relationship between interest rate changes, percent changes in real interest rates, and percent changes in gold prices. Quarter to quarter, since 1968, the relationship is 16%. 16% of the time, one's rising and the other one's falling. Negative 16%. Right? The other 84% of the time, either they're falling or rising in tandem, or there's no correlation. One's rising, the other one's doing nothing. One's falling, the other one's doing nothing. So the relationship between interest rates and gold prices is not what a lot of people think. It's not a very simple formula that you could say interest rates are rising, ergo gold prices have to fall. Interest rates are falling, ergo gold prices have to rise. That's how investors lose money, believing stuff instead of looking at numbers. If you look at it in a different way, I think the R squared between the two is something like 0. Which is one of the reasons why a lot of institutional investors like gold and silver, because it has zero correlation between both short rates and long rates. It's a perfect portfolio diversifier. The other thing to watch is the real interest rates. This is percentage change in any given quarter, or a month rather, of gold prices at different real interest rate environments. And you can see from negative 3% to 1%, the gold price has tended to rise monthly on average when real interest rates, adjusted for inflation, have been 1% or less. Around 2%, it's kind of flat, and around 3% real interest rates, it becomes a negative factor. At 3% real interest rates, investors, any number of investors, seem to say, I can live with a 3% real inflation-adjusted return on my treasuries. I'm going to lighten up my gold position and increase my T-bills. Obviously, some people do that earlier. Some people do it later. It's very important to watch going forward, because if it's that 3% threshold that we have to pay attention to, interest rates, these are T-bills, I believe, interest rates are about 4.2%, 5%. Right now, inflation's around 4%. You've got a real interest rate that's gotten up to 1%. That's not particularly worrisome vis-a-vis gold prices. If you go back to that previous chart and you say, well, what about those 16% of the time when higher interest rates are meaning lower gold prices or vice versa? When the higher interest rates have an effect on gold prices and it shows up in that quadrant on this chart, is when real interest rates are higher than 3%. So you have to say, okay, are we worried about this? Because inflation has been coming down and interest rates have been rising for most of the last 18 months. So you have to worry about that. But with inflation rates falling and with interest rates falling, you get a situation where you're saying, okay, we got up to about 2%, maybe a little over 2%, depending on how you measure real interest rates. And that's starting to get close to that 3% trigger point. But now with interest rates falling, nominal interest rates falling faster than inflation, you say, okay, now it's closer to 1%. So gold market investors can exhale. Something to watch going forward over the course of the next year and really for the rest of the time that you're investing in precious metals. It's very important to watch. So what does all this mean for gold, silver, and PGMs? For gold and silver, the first order of importance are these real rates. That 3% guideline, it's not carved in stone, and past performance is no guarantee of future performance, and relationships do change. Look at all those guys who were predicting a recession for the last 5 years predicated on an inverted yield curve. Relationships change, but that's something to watch. And that's the most important factor driving gold and silver because it's the real return on competing assets, i.e. lower risk U.S. Treasuries, that is the key factor determining whether or not investors are buyers or sellers or standing aside in gold and silver. And therefore, that is the key set of factors that determine rising or declining gold and silver prices. So the first order of importance in interest rate markets for gold and silver are their effect on investors vis-a-vis the competitive nature of potential or hypothetical returns in gold and silver relative to interest rates. And there were people who were talking about gold rising 10-fold or 20-fold or 62-fold. But realistic, sober, intelligent investors don't have those kinds of expectations. And historically, 3% real returns have been attractive enough for them to shift away from gold and silver. There's a second order effect for gold and silver, and that is the effects that the interest rates change on have an effect on real economic conditions and competing financial assets, other interest-bearing assets, corporate bonds, stocks, and currency markets. That also has an effect. So it's that interest rate as the prime mover has a direct effect on gold and silver investment demand and prices. And then it has a secondary effect as it influences investor attitudes towards stocks, bonds, currencies, and other investments that they can make. With PGMs, it's all about the economy. If interest rates are turning off demand for automobiles, then they'll make fewer automobiles, and you need less platinum group metals, and the price will fall. It's kind of a simple math, actually. That's all I've got now. I've gone on longer than I wanted to. You can become a CPM Group client by buying our yearbooks, a package of our yearbooks, or becoming a retail investor client or a larger client. You can go to our website, cpmgroup.com, read about the different services and research that we offer. We've written a couple reports on the longer-term economic outlook, excuse me, and the relationship between deficits, debt, and gold. We'll throw those into the package if somebody, becomes a client of CPM Group yet this year. Next week, we will be doing a open forum for our clients on the December 6th. I think it's at 11 p.m. Eastern time. It's on the internet, and it's an open question and answer period. We don't have a prepared presentation. You just can come and you could ask us questions like, we'll answer the reasonable ones. That's all I have for now. You can go to our website, as I said, read about stuff. You can send us an email at info@cpmgroup.com and say, I want to be your client and let's talk, and we'll try to get back to you. I'll be back with you next week, hopefully in better health with a better voice and not coughing in the middle of a presentation. In the meantime, have a good weekend. Take care of yourself. Take care of everybody around you. And look out the window and see what you can do to help the world because we need help. Take care.